In 5 minutes, I found 5 trading opportunities worth thousands using the Fibonacci retracement, but most traders miss out on huge opportunities because they don't understand how Fibonacci retracement works. So over the last month, I tried and tested a numerous amount of trades using the Fibonacci retracement, and my trades have become more precise and profitable. Now, they're a key part of my trading strategy, and they might be the solution you've been looking for. So in the next 10 minutes, I'm going to show you how this simple tool can help you find high probability entries and exits like a pro. Now, you may have watched my last video about the Fibonacci. And secondly, did you watch my latest video where I spoke about the one candlestick pattern that you need to be successful? Now, I'm going to try to combine those two. And if you haven't, I suggest you watch those two videos first before we get to this part. Let's head over to the chart. So as you can see, we've got the pound yen. Now, as you can see, I'm using 2 moving averages, okay? I'm using a 20 and a 50. There will be a video about moving averages. But if 20 is below the 50, we focus on selling moves. If 20 is above the 50, we focus on buying moves, okay? Now, the main part of this strategy is understanding that we are phase 1 traders and we're always looking for the next phase 1. So what's a phase 1? A phase 1 are long moves in a trend direction. So as we can see here on the pound yen, okay, we have a big move to the downside here, right? And the market pulls back to the moving averages, making a lower high, and we go back down here. Now, where does my Fibonacci strategy work great here? So I like to use it, start off with a daily time frame. And remember, Fibonacci's are there to help us identify support and resistance levels to where the market can react. As we can see here, this is a phase 1 down, also known as a lower low. All right, so let's just remove this. Now, the most simple way to draw it will be from this part here. So the last swing, which will be from here, the high to the low. And as you can see, the market came up past the 23.6, past the 38.2, past the 50%, came near the 61.8%. Now, I'm not saying you have to trade off it straight away off this strategy. What I want you to do is identify how the market reacts off one of these levels. As we can see, the market pulled back to this area between the 50 and the 61.8%. Now, the key part of this strategy is once we've identified that, our next objective is to start looking for sell positions. So what are we going to do to look for these sell positions? The key thing we're going to do right now, there are 2 ways. There are several ways. I can make thousands of ways out of this. The key thing is once you've identified the market has resisted off this level, the key thing we're going to do here now is then drop down to the lower time frame. So what I'm going to do is going to put a vertical line there. So as we drop down to the lower time frame, it will make sense. And the key thing you have to do is we're going to still use the EMAs, and we're going to take the first crossover to the downside and the retest of the 20 EMA. So as we drop down now to the 1 hour time frame, as you can see, this is where the market reacted. The first thing we're going to do is when the market crosses to the downside and gives us a lower low, a lower high, at this point here, we want to start selling. Now, you may not be awake at this time when the market gets there. Obviously, this is around about midnight. But what you're going to do then is any time, what we're going to do here is we can drop down to the 30 minutes. And this is where a simple strategy called the 20 bounce is after it crosses over, the first touch on the 20 EMA is where you're going to take that sell. So as you can see right there. Okay. Soon as it touches the 20 EMA, you take that bar and you're going to sell. So if we look at the bigger picture, right, you have this big move of a lower low, lower high on the daily. And then soon as 20 crosses the 50, after it touches that level, and as you can see here, you had another opportunity. So the market made a lower low, didn't touch here, lower low, lower high. You could have sold there. Now, some of you might say, hey, but the market pulled back. Not to worry. See, the key thing here now is you are going to look for 20 points. We're going to use a 20 EMA as a resistance in this downtrend. And what we're going to do, whenever that bar closes, okay, whenever that bar closes, that touches that 20 EMA and closes, so like here, you're just literally going to sell after that bar, all right? And you're going to look for 20 pips. Now, some people aren't going to like what I'm going to say here because everyone's like, oh, risk management. But this is a beginner strategy that's going to work for you, very effective if you get this right. Now, this is the beginning stage. The beginning stage here is just to get comfortable in using the Fibonacci as a resistance in a downtrend to look for shorts using the moving averages. We're not doing any price action or candlestick entries. We're just, if it touches the 20 EMA, what we want to do, the bar that closes, you're going to sell on the next bar open, which essentially will be there, and you're looking for 20 pips. Now, where do you put your stop loss? Now, your stop loss is going to be 40 pips. Now, some people are going to say, hey, why are you risking more than what you're going to make? At the moment, I want you just to get comfortable. Make sure your risk is low, right? And your lot sizes are correct. Luckily, Smart Charts does it for you, and I'll show you how. But as you can see, you would have made money. Now, if we done the same thing here, the bar that touched the 20, which was actually here or here, okay? Even if you took 20 pips and you risked the 40, now people say you're risking twice as much, yes. But the probability of getting the direction right with the EMAs means it looks like this. There's your 20 pips. And there's your 40 pips. And as you can see, you just might get lucky in staying in the trade. Now, if we done it on this one, right, based on this bar, or even this bar maybe, you would have been able to survive the trade and catch the profits. It's very simple. Now, if we go back to the higher time frame, and let's say we identify this as another swing down, we could draw Fibonacci from the high to the low here, 1 to the 2. Now, as you can see, the market came now to this 61.8%. So at this area now, we're looking for shorts. So as I drop down to the 1 hour first, I start with the 1 hour, just to get an idea. Look, you can see the market really resisted off that 61.8. So then I drop to the 30 minutes. And all I'm going to do, the first crossover is where I start looking to place my trades. Market made a lower low, lower high. You could have short there 20 pips. Okay? You could do the same thing here, 20 pips, 20 pips, 20 pips, 20 pips. So now you're probably thinking, how do I enter and exit? So I like to use Smart Charts. The reason why I like to use Smart Charts is because the strategy is already built in. With the correct EMAs and the right Fibonacci drawings, remember Fibonacci's can be subjective. Once you've got that direction right, look how easy it is to find entries and exits in the correct direction. And these arrows are literally telling you it's touched a 20 EMA and we're going to automatically work out the risk for you and you'll take profit. So for me, the reason why this strategy is so good is once I've identified where the market is, I can focus on capturing the next short. So if we were to draw Fibonacci now from here to here, once the market touches any of these levels, the first crossover and the first 20 bounce to the downside is going to be the first trade I take and hopefully bag me 20 points, piggy banking off the trend using the higher time frame. So you could do this with an uptrend or you can do this with a downtrend. So I want to show you what the concept really is. So if you have here a higher high, a higher low, and a higher high, and you draw the Fibonacci correctly from the high to the low, from the low to the high, sorry, let's say market reacts off this Fibonacci level. We're not trying to trade off that Fibonacci level, but if the market begins to move, we want to piggy bank on that trade on a lower time frame. At that point, this is where we can get easy trades with the trend and piggy bank off that move. Now, there are many ways you could enter risk management, 2-to-1s, 3-to-1s, or risk twice as much. But as a beginner, where you are right now, and you really want to use Fibonacci's, okay, you need to get this concept of using the higher time frame to identify the structure and the trend, and then piggy bank on the lower time frame once the market gives you a clear crossover and bounces off the 20 EMA using the 30-minute time frame. Now, a little bonus here. Now, if you want to identify where this phase one goes, this is where you use a Fibonacci extension and it goes up. And let's say it resists off that 50. Now we can use these as potential targets so we can maximize our profits in a trending market. And another bonus, like I said, if you watch the candlestick videos, another key way to begin drawing Fibonacci's is by looking at those bullish and bearish engulfings. I'm not saying it's the holy grail, but there is a way where you can use this by identifying bullish and bearish engulfings. Let me explain. So if we take this first bearish engulfing to the next bullish engulfing, so let's draw it. You have to watch the other video to understand this. So this is right here, this is a bearish engulfing. So we take the high of the bearish engulfing and take it to the next bullish engulfing pattern. So it's a bearish pattern to a bullish pattern. And as you can see, do you see how the market reacted beautifully off the 61.8? And now we have a bearish engulfing. So what trade ideas do you think I'm now looking for the week ahead? I'm going to be looking for shorts. At this point, I can drop down to the 30 minutes now. And what I'm going to look for is when the blue crosses below the red and the market makes a lower low and it pulls back and resists off that EMA. I'm going to look for a short and hopefully bank in 20 pips. So you could take your trade into the next level when you watch those two previous videos, like I said. So watch the videos here right now, and I guarantee you're going to look at the markets in a different way now knowing how to use these tools.